Hey everyone, my name is Kendall. I'm a founder of a company called Proximity that builds DeFi applications on the Near blockchain. And we are going to chat a bit about designing a sustainable ecosystem program. So just a heads up on what we're going to cover. So first we're going to touch on how new ecosystems emerge on L1s and L2s. We're going to cover the types of ecosystem programs and how they can accelerate development, along with some advantages and disadvantages of each of them. And then finally, we're going to touch on how to make them sustainable. So first off, what makes a healthy DeFi ecosystem? Another heads up, this will be mainly focused on DeFi ecosystems. So there's three major components, certainly many more things, but capital, core components and primitives, and liquidity. So what do we mean by capital? By capital, I'm talking about valuable assets that are available on-chain. So at a minimum, and Bitcoin is probably the best example of this, you need a liquid base token. So obviously the base token, Bitcoin, that's pretty much the entirety of that protocol. And most of this capitalization actually happens off-chain. So you can trade Bitcoin on centralized liquid exchanges. And essentially what you can do is look at the total market capitalization of that chain based on the market capitalization of Bitcoin. Obviously with something like Ethereum, it gets way more interesting because you can issue an infinite number of assets and you can have markets both on-chain and off-chain. I think what's interesting to point out here about Ethereum, and most of you probably know this, but the ICO boom was really what kicked off and played a major role in the capitalization of Ethereum. Prior to the ICO boom, all you had was Ethereum as the asset that was on chain, and post ICO boom, you have now thousands of assets and also way more interesting sort of capital formation structures. On newer L1s, what we've pretty much seen is the vast majority of this capital actually comes from bridges to Ethereum. And now we're starting to see these bridges go between these new L1s and L2s, which allows new sort of bootstrapping protocols to tap into the capital markets that exists on various chains, but still primarily Ethereum. So the second major component of or aspect of a healthy DeFi ecosystem is the core components. So there's two sort of major frames of core components as I see it. So you have primitives. The best thing to think about here is sort of a token standard, something like the fungible and non-fungible token standards that exist on Ethereum. And then, getting a little bit more like in-depth and closer to an application is something like a, multi-signature wallet or account. You could even throw a sort of DAO framework, so like the idea of DAOs and how they can operate in here as a primitive as well. And then you have these minimum viable components and applications that are critical for these healthy ecosystems. So just a few examples here. You have DEXs, oracles, which enable lending protocols, derivatives, all these like longer tail, interesting sort of like higher level solutions. And then as we mentioned before, bridges are easily one of the most important core components for new chains. So onto liquidity. So we talked about capital and how capital can actually just be based on the value of assets with off-chain exchanges. For a healthy DeFi ecosystem, you need liquidity to exist on-chain, at least if you want to get anywhere near Ethereum's level of success. So I think there's sort of two eras here so far, and there's going to be many more, as to what your strategies that are available when it comes to attracting liquidity. So you have kind of the pre-synthetics SNX token liquidity mining strategy and comp. And your options there, you could have provided your own liquidity on Uniswap. You could have been listed on a centralized exchange. You can work with market makers and use them in tandem with providing your own liquidity or listing on a centralized exchange. All these very expensive. Or you could do an initial DEX offering, which, again, very expensive and capital intensive for the core team, who'd usually have to put up, their base token and then USDT or ETH or some other part of the pair. Once we have the sort of creation of liquidity mining by the synthetics team and then getting popularized by the compound team, things start to get more interesting. So you have liquidity mining, basically just giving away your token to incentivize more people to put liquidity into your token, usually on a DEX. The idea of a pool too, which is usually your base token, and then Ethereum or another token, you actually put the highest amount of rewards into that pair because you're expecting it to be a little bit volatile. More recently, we've seen the Olympus Ohm style bond, which is actually where protocols are buying their own liquidity, which is kind of a fascinating development. And the one that we're actually going to cover in a little bit more detail here is this brand new idea of sort of liquidity as a service. So if the Ohm-style bond is a protocol buying liquidity, where you're actually kind of purchasing the LP token as a protocol that you could own permanently, liquidity as a service offered by projects like Tokamak and Fei and Ondo is more like renting liquidity. And we'll talk about kind of how you can do that. So yeah, like those are sort of the three major components of a healthy ecosystem. Now, how do you sort of accelerate the development of those three major components? So there's a few different types of ecosystem programs. I think the common theme is that the goal really is to accelerate those three different things that you're aiming for. And the different types that are available to you, you have grants, liquidity mining, rewards programs, that liquidity as a service we talked about, and ecosystem DAOs. So what are grants programs? That's probably the simplest one, the one just about everybody is familiar with. High level, it's providing some kind of equity-free grant to a team or an individual to deliver some kind of project or component. Usually these range around 1K to 20K. In some extreme cases, they can be as high as several million, but usually they're like much smaller amount, although those are kind of starting to trend upwards. These are especially useful for public goods, just kind of the nature of them. You know, the only expectation is that they sort of deliver usually this sort of open source component or this open source sort of project. It's a little bit less suitable for something that's, you know, intended to generate revenue. The Ethereum Foundation used this in a big way with Uniswap, and even more interestingly, their ETH2 clients. You know, pretty successful there. But what are the disadvantages? So these are oftentimes difficult to manage. Grants programs can have a high overhead. If you want to make sure that they're successful, then you should be having some kind of milestone set up with the team, some kind of regular check-ins. And if you don't do that, then they can be unreliable. You know, teams might kind of, you know, miss milestones, they might disappear, or they might just lose interest. Sort of related to this, a lot of times grants are not particularly sustainable for many teams. You know, like grants are usually milestone based, so that might only get them to some part of their project. You know, if they aren't ready to raise funding, or if it is a public good and that's not even really a suitable option for them, they're gonna have to reapply to grants and sort of, you know, go through this process over and over. Not necessarily a great option. And then oftentimes if you are a revenue generating project, something like a grant is unsuitable. Now, at Near, we actually have used this for projects that have those ambitions, as long as they are interested in making their project open source. So that's not necessarily a blocker, but usually not the best approach. So this program has gotten super popular lately, the Liquidity Mining program, and we're talking about at an ecosystem level. So this is basically where you're supplementing the lower level project protocol level strategies like Aave, for instance, or Compound, with the base token from the new layer 1 or layer 2. Polygon was the first one to implement this and did so quite successfully. They, you know, really accelerated the growth of their ecosystem and attracted a lot of capital through this. More recently, we've seen Avalanche come out with a similar program and you know, attempt to replicate that success. The biggest benefit of a liquidity program is that it provides a strong incentive to move capital. So usually there's going to be some sort of cost to users, either in time, in, you know, gas fees on the base layer and the new chain, and then just opportunity cost from those two things. So they need some sort of really strong pull in order to actually use the bridge, in order to try out these new protocols, in order to really, you know, connect with your chain. And so yeah, that's a really important part of the liquidity program. And then I think most interesting actually is this can kind of provide a boon for these newer projects, these projects that aren't yet ready to launch their own token, or maybe never want to launch a token, but they're looking for these initial users. And when you have an ecosystem-wide liquidity program, that can give these newer projects an opportunity to you know, get users to test out their model and test out their new flow without having to, you know, consider their own token. The disadvantages, there are quite a few here. I think, you know, it's very expensive to do these programs. You are pretty much directly paying for some amount of capital for some amount of time. If you look at the size of these programs, at the ecosystem-wide level, they've been in the hundreds of millions of dollars. Certainly not cheap. There certainly are some regulatory considerations. I mean, we haven't really seen much clarity yet on like how regulators are going to treat these programs, but that gray area, you know, does make things a little bit, you know, concerning. There definitely are diminishing returns here, and that's part of this being expensive. You know, like you could throw a lot of capital at these projects, and eventually there's sort of a max amount, even with a really high APY, the capital you're going to be able to attract. And oftentimes this capital that you do attract will move to another chain, another protocol, the second that your sort of level of return isn't the highest. And that sort of leads to these not really being the most community-oriented strategies. So rewards programs are kind of an interesting alternative or even value add to liquidity programs. This is actually discussed a little bit in the previous talk by the UMA guys. This is where you can reward teams or even individuals tokens based on some KPIs, some metrics that they're going to hit. Two really good examples of this. So Blockstack started this with their app mining program. This is basically where they put up essentially a bounty for new teams to build apps that were built, like deploy apps to Blockstack's blockchain. Phantom has done this more recently. And then what they do is they actually base it on the total value locked, so like the amount of assets that each individual team or project is able to attract to the Phantom chain, and they give away their native token to these teams. What's nice about these programs is they are a little bit more open. Usually you set some strict rules on what does it take to qualify, and then there's no necessary like pre-existing relationship. There's no BD that's really required. It's sort of like you say, hey, look, we put this up, we did this, it's verifiable on chain, and then you get the reward. Whereas usually these liquidity programs involve some kind of discussion between the two teams about what's, or at least two DAOs about what's going to work out best to achieve the goals. The drawbacks here being that anytime you have a program that's sort of set in stone that has some clear rules, it is potentially gameable, and it's sort of this what's called like an infinite game where you set up like one set of rules, they get gamed, and you set up another set of rules, and it just continues to get gamed. I mean, this is something that led to Blockstack to can their app mining program. We'll see how effective it is on Phantom. So yeah, related to that, they usually are not very strategic, and a lot of times these are used more successfully for teams than for users. So you're not necessarily going to attract capital unless the team figures out a way to like pass on these gains that they make to their end users. So here's where we get into some of the newer types of programs you can do. Those previous three have been used for a while now. I think that this is going to be sort of the next wave of what we see for these programs and get into how we can make them more sustainable. So like we mentioned before, this liquidity as a service, this is where you're kind of renting liquidity, is a really interesting idea. It's being used for the individual project, but is yet to be used ecosystem-wide. So if you use your base token as a new ecosystem, say that's Near, say that's Avalanche, what you can do is you can actually make it so that your community and your holders can provide liquidity to newer projects that are trying to bootstrap their own liquidity without needing to acquire another token. So that's called single-sided liquidity provision. Some projects that sort of enable this, the Tokamak, Ondo, and Faye, they allow you to basically do this renting of liquidity, and this basically just minimizes the risk for your community and also allows them to stay invested in your base token and in your main asset layer while also providing support to these newer projects that are launching. A key benefit of this is it's actually relatively cheap as compared to just giving away the tokens in a liquidity mining strategy, which at least in theory makes this a little bit more long-term sustainable. You're not really going to run out of tokens, at least not very easily. The biggest drawback here is that it's not quite ready yet. We're going to see on Ethereum Tokamak launch, I think in the next couple of weeks. They have aspects of the program live, but they're going to launch the actual liquidity provision pretty soon. And then Ondo and Faye are trying this out in a smaller level, but I think we'll see that develop over the next couple of months as well. I think the second major way that you can enhance those other programs that we talked about is by making them into a DAO. What are the benefits of this? Well, you make it way more community-driven. You potentially diminish regulatory risk, and you give your the key players in your ecosystem a way to really direct the sort of evolution of your chain, and also back other key players on your team. So I think a good way to do this is you start with just the core ecosystem representatives, and then over time you can broaden this into be way more of a community-driven program. This allows you to set up a really clear, transparent process for teams and participants, as opposed to some of these other programs that are less transparent. And then potentially you can actually achieve some regulatory advantages too, by not having any sort of clear domicile through which this has been done. It's going to be way more distributed as far as the control of this program, and you might reach that sufficiently decentralized moniker that a lot of regulators have been throwing around recently. All right, so wrapping up here, thinking about all of this we just talked about, how do we wrap this into a path to sustainability for these ecosystem programs? I think the most important and high-level takeaway here is that you should combine elements of these grants programs, the rewards, and the liquidity programs, and aim to distribute them via DAOs. What are the advantages of doing so? This will help you attract quality teams and projects. You can create early winners that reinvest in the ecosystem. This is sort of the wealth effect that a lot of people talk about. You have these early teams, these early individuals that do well with certain projects, and then they want to reinvest in the ecosystem and create more winners and attract more teams. It makes it easier to keep this capital and liquidity on chain. If you have a clear process and also like a sustainable via liquidity as a service type of approach, then you don't just have mercenary capital come in through the 6-month duration of your ecosystem-wide liquidity mining program. You have sort of a path to repeating this process over and over again, ideally for years or even longer. And most importantly, you give the community a voice and also eventual ownership over these different programs. All right. Well, yeah, thanks, everyone. This is, if you are interested in learning more about near or proximity and how we might implement some of these ideas, you can follow us at proximity.fi on Twitter, or you can follow me at Kendall C. Cool.